There is one trading framework that has stayed consistent through every market condition I've traded. Bull markets, bear markets, high volatility, low volatility. It doesn't rely on indicators, it doesn't rely on patterns, and it doesn't rely on predictions. It relies on how price actually moves. This is not a holy grail strategy. It's a professional framework built around probabilities, structure, and risk. And if you understand it properly, you can apply it to Forex, indices, commodities, and even crypto. By the end of this video, you'll understand exactly how to read market direction, where high probability entries come from, and how to filter bad trades before you ever click buy or sell. The framework has 3 steps. Miss one of them, and the strategy falls apart. Get all 3 right, and trading becomes simple. The first step is market structure. Market structure is the foundation of everything. If you misread structure, nothing else matters. You could have perfect entries, perfect risk management, perfect execution, and still lose simply because you are trading against structure. Most traders think they understand trends, but they actually don't. Yes, everyone knows that higher highs and higher lows mean an uptrend, and lower highs and lower lows mean a downtrend. That part is basic. The problem is how traders define those highs and lows. Not every high or low on the chart matters. A low is only valid if price moves from that low and breaks the previous high. If price drops, then moves up but fails to break the prior high, that low does not matter. It is not confirmed. It is noise. The same logic applies in reverse for highs. This single rule eliminates most false trend reversals. So in an uptrend, the market is only considered bullish as long as the most recent valid low holds. Price can pull back, spike, move sideways. None of that matters, unless that valid low is broken. Traders lose money because they assume every pullback is a reversal. Professionals wait for confirmation. Once you understand this, structure becomes objective. No guessing, no opinions. If structure is bullish, you only look for buy trades. If structure is bearish, you only look for sell trades. Anything else is gambling. The second step is supply and demand. Supply and demand zones are areas where institutions previously made strong decisions. You don't need to guess where they will act. Price already showed you. A demand zone forms when price consolidates and then explodes upward. That explosion tells you large buyers were active. If price returns to that area, there is a strong probability buyers will defend it again. A supply zone is the opposite. Consolidation followed by aggressive selling. If price returns, sellers often step in again. The key rule is simple. You buy from demand and uptrends. You sell from supply and downtrends. You do not mix them. You do not trade demand in downtrends or supply in uptrends. That mistake alone destroys accounts. How you mark zones also matters. You don't draw huge rectangles across the chart. You mark the candle or base just before the impulsive move. That area represents imbalance. That is where price left unfinished business. Once the zone is marked, you wait. You do not chase price. You let price return to you. This is where patience separates amateurs from professionals. When price enters your zone, you wait for reaction. You don't enter blindly. You wait for confirmation in line with structure. Stop loss goes beyond the zone, not inside it. If price breaks through your zone cleanly, your idea is wrong. You exit without emotion. Take profit is placed at logical structure, recent highs and uptrends, recent lows and downtrends. Which brings us to the third step, risk to reward. This step is what turns a decent strategy into a profitable one. You only take trades where the reward is at least 2.5 times the risk. Anything less, you skip the trade, even if everything else looks perfect. This rule alone filters out most losing trades. You don't need a high win rate if your risk to reward is solid. A trader winning 45 to 55% of trades can be consistently profitable with proper risk management. That's the entire framework. Structure first, zones second, risk to reward last. You repeat the same process every day. No emotions, no improvising. Now here's something most people ignore. Even the best strategy fails with poor execution. Slow fills, wide spreads, slippage, these things destroy edge. That's why broker choice matters more than most traders realize. If you're serious about trading this framework, you need a broker with fast execution, tight spreads, and stable platforms. Otherwise, you're fighting the market with a handicap. That's why we recommend the brokers linked below. They offer strong trading conditions and exclusive bonuses up to 2 on your first deposit. Available only through our links.